The Federal Reserve just cut interest rates by 1/4%, and they've now changed the projections for the remainder of the year. They went from projecting only 2 rate cuts for the year to having 3 rate cuts, which would mean that they would most likely be cutting interest rates at the October meeting as well as another one at the December meeting. And it's all because of how bad the labor market is doing at the moment. This is all being priced into the stock market as we speak, which is why we see it continuing to reach a new all-time high almost every single day. Jerome Powell spoke about it during the Fed conference on Wednesday, and he said the quiet part out loud. He said that 1 rate cut wouldn't automatically fix the mess that we're in, but we have to look at the entire path of rates. Then he proceeds to walk it back a bit, but it's looking like more rate cuts will be on the way. But take a listen.
Declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a 1/4 percentage point now is going to arrest that?
Well, I didn't say that I thought a 1/4 point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that, you see minorities, unemployment going up, you see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
So it sounds like to me that they will definitely be cutting interest rates a few more times this year. And again, it's because of how bad the labor market is. I talked about this in a previous video, but there were a number of employment data revisions over the last few months, and that alone is the reason why the Fed completely changed their stance on interest rates. Jerome Powell also spoke about that as well. So take a listen.
The situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality.
So the Federal Reserve will likely continue to cut rates in the October meeting, and if you take a look at the CME Fed tool, you'll see that there's a 92% chance that they'll be cutting interest rates by another 1/4%, and a 78% chance of another rate cut in December. Just a reminder that as the Federal Reserve cuts interest rates or even talk about cutting interest rates, the stock market goes up. And the reason for that is because it helps boost the overall economy by making it cheaper for everybody to borrow money. And when people have more money in their pockets, they tend to spend it, which will then lead to increased sales for businesses all across the board, and the sales will show in the quarterly earnings report, making the stock to go up. And if people don't spend the money, they invest it, which will also make the stock market go up. So it's kind of a win-win situation. But it doesn't only make it cheaper for the ordinary person to borrow money, it also makes businesses hire more people to meet the demands since the products are flying off the shelves. And it also helps boost innovation since they have more money. And more innovation will draw in more demand, and more demand means more hiring. So I'm all for interest rates going down. It kind of makes you wonder, why don't they just put interest rates down to 0? Well, there's a few downsides. Some will say that the economy will end up being worse later on down the road with lower interest rates. And that's because if the Fed's not too careful, lower interest rates can end up increasing inflation. As I said earlier, if it's very cheap to borrow money, then everybody will have more money to spend. And the more demand for specific products, the more that these businesses increase their prices. And if more people keep buying that specific product, the higher that these businesses will increase their prices. And that's how it leads to higher inflation, which is why Jerome Powell also spoke about keeping an eye on inflation as they change their policies, as well as having a lot of positive things to say about the economy. Here's a quick video.
Let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there's a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
But just remember that there's going to be a lot of data coming out from now until the next Fed meeting. There's going to be a lot of inflation data coming out, as well as more job data. If inflation shows that it's cooling, the Fed might get the green light to cut rates at a bigger pace. There's also going to be a number of job data coming out as well, so stay tuned for all of it. And if I gave you any value from this video, please give it a thumbs up and subscribe. Really appreciate it.